There is a question that keeps most investors awake at night, and that question is, why do some people keep making money while others keep losing it, even when both groups are equally intelligent, equally hardworking, and equally motivated to succeed? The answer is not luck. The answer is not insider information. The answer is not some secret formula hidden behind the doors of the world's most powerful financial institutions. The answer, surprisingly, was developed by a small, quietly brilliant group of Swiss bankers and speculators based in Zurich, Switzerland, and it was later brought to the wider world by a financial writer named Max Gunther. What you are about to hear is not a collection of comforting advice. It is not the kind of cheerful, feel-good financial guidance that tells you everything will work out as long as you stay positive and trust the market. In fact, much of what you are about to hear will challenge almost everything you thought you knew about money, about risk, about planning, and about what it actually takes to build real, lasting wealth. Some of it will make you uncomfortable. Some of it will contradict the advice your bank has given you, the tips your colleagues have shared, and the strategies that popular financial media has been promoting for years. That discomfort is precisely the point. The Zurich Axioms, as Max Gunther presented them, are a set of 12 major principles and a series of connected minor principles that govern the behavior of successful speculators. And when we say speculators, we do not mean reckless gamblers. We mean people who understand that every financial decision carries uncertainty, who accept that truth honestly instead of pretending it away, and who have developed a disciplined way of navigating that uncertainty to come out ahead more often than they fall behind. The men and women who originated these axioms were not professors. They were not theorists. They were practitioners. They were Swiss bankers, traders, and investors who had built and preserved serious personal wealth across some of the most turbulent decades in modern financial history. They had survived the Great Depression. They had navigated 2 world wars. They had watched currencies collapse, governments fall, and entire industries disappear overnight. And through all of that, they had managed to keep growing their money. Not by avoiding risk, but by understanding it. Not by predicting the future, but by positioning themselves wisely in the face of uncertainty. Max Gunther spent years studying these people, talking to them, observing their habits and their reasoning, and gradually, he extracted the core principles that seem to separate them from the vast majority of investors who stumble, hesitate, second-guess themselves, and ultimately end up with less than they started with. He then wrote those principles down in a form that anyone could understand and apply, regardless of their level of financial expertise. What follows is a deep, careful, and honest exploration of every one of those principles. We will move through each axiom one by one, examining what it means, why it matters, how it runs against conventional wisdom, and most importantly, how you can apply it in your own financial life. Whether you are someone who has been investing for decades or someone who is just beginning to think seriously about how to grow their wealth, the Zurich Axioms have something important to offer you. So let us begin. Let us begin with the foundation of everything, with the very first and most important axiom, the axiom that sets the tone for all the others, the axiom that most people spend their entire financial lives trying to avoid. The first axiom is about risk, and it states this: worry is not a sickness, but a sign of health, and if you are not worried, you are not risking enough. Now, stop right there and really let that sink in. In a world where financial advisors constantly tell you not to panic, not to worry, to stay calm, and trust the process, here is a radically different message. Here is a message that says your worry is not something to be medicated or managed away. Your worry is information. Your worry is telling you that you have something at stake, that you are genuinely engaged in the game, that you have put real capital into real uncertainty, and you are paying attention to what is happening. That is not a weakness. That is the necessary condition for financial growth. The deeper principle embedded in the first axiom is this: You cannot get rich by playing it safe. Safety, in the financial sense, is an illusion. The bank account that never loses money is also the bank account that never gains enough to outpace the slow erosion of purchasing power caused by the steady rise of prices over time. The government bond that is backed by the full faith and credit of a stable nation is considered safe, and yet the return it offers, after accounting for the way prices rise year after year, is often so small that it barely keeps your wealth intact, let alone grows it. Real wealth, the kind of wealth that changes your life, the kind that gives you freedom and options, and the ability to make choices on your own terms, comes from taking risk. Not blind, reckless, uninformed risk, but deliberate, calculated, eyes open risk. The Swiss speculators who developed the Zurich Axioms were not afraid of risk. They embraced it. They understood that in a world of genuine uncertainty, which is the world we all live in, the only way to participate meaningfully in the upside of financial opportunity is to accept that you might also experience the downside. They did not pretend that certainty was available. They did not search endlessly for the investment that could never fail. Instead, they learned to make peace with the reality that every worthwhile financial move involves the possibility of loss, and they developed the skills and the mindset to handle that possibility without being paralyzed by it. There are two minor axioms that connect to the first major axiom, and they deserve careful attention. The first minor axiom says, always play for meaningful stakes. This is a principle that flies in the face of the popular idea that you should start small and only risk what you can comfortably afford to lose without feeling it. The Zurich approach says the opposite. It says that if the amount you are risking is so small that losing it would not genuinely affect you, then you are not learning anything useful and you are not truly engaged in the process. You need to have real skin in the game, a real stake that matters to you, because that is what sharpens your attention, improves your decision-making, and ultimately teaches you the skills you need to become a successful speculator. This does not mean gambling your rent money or risking your family's security. It means finding the level of risk that genuinely makes you pay attention. It means not being so cautious that you insulate yourself from the learning process that only real stakes can provide. The second minor axiom says, resist the allure of diversification. Now, this is perhaps the most controversial principle in the entire book, because it goes against one of the most sacred doctrines in conventional investment advice. You have been told your whole financial life to diversify, to spread your money across many different investments, so that if one goes down, the others cushion the blow. The Zurich Axioms say that while this approach does protect you from catastrophic loss, it also mathematically guarantees that you will never achieve spectacular gain. If your money is spread across 20 different investments, then when one of them triples in value, the effect on your total portfolio is modest. But if that same investment represents a meaningful portion of your portfolio, that tripling changes everything. The Swiss speculators concentrated their bets. They chose their opportunities carefully and then committed to them seriously. They were not cavalier about this. They did their homework. They assessed the situation as carefully as they could, and then they committed. Because they understood that the relationship between risk and reward is not just a slogan, it is a mathematical reality. You cannot have one without the other. Now, let us move to the second axiom, which is about greed, and which says, always take your profit too soon. This one surprises people, especially people who have been taught that the secret to investment success is patience, that you should buy good assets and hold them for as long as possible, letting compound growth do its work over time. The Zurich axiom about greed offers a very different perspective. The principle here is rooted in a deep understanding of human nature and market behavior. Markets go up and markets come down. Prices rise and prices fall. There is no asset in the history of finance that has gone up in a straight, uninterrupted line forever. Everything that goes up eventually comes back down, at least partially, and often significantly. The question is never whether a price will eventually correct. The question is only when. Now, here is the problem with greed. When an investment is going well, when the price is rising and you are making money, there is a powerful psychological force that makes you want to hold on just a little longer. You think, it has already gone up by this much. Surely it can go up a little more. You think, I do not want to sell too soon and leave money on the table. You think, maybe this time is different. Maybe this particular investment will keep going up indefinitely. And so you hold, and you hold, and you hold. And then the price turns, and it falls. And sometimes it falls so fast and so hard that you end up giving back most of the gain you had accumulated, or in the worst cases, ending up below where you started. The Zurich approach says, do not let that happen. Decide before you invest what return would satisfy you. Set that target, and when your investment reaches it, sell. Take your profit. Move on. Yes, you might sometimes sell right before the price goes even higher, and in those moments, you will feel a pang of regret. But that pang of regret is far less painful than the alternative, which is watching a beautiful gain dissolve because you were too greedy to take it when you had it. There is a powerful minor axiom attached to the second major axiom, and it says, decide in advance what gain you want from a venture, and when you get it, get out. This sounds simple, but in practice, it requires tremendous discipline. It requires you to make a plan before your emotions are engaged, before the excitement of a rising investment has begun to cloud your thinking. It requires you to decide coldly, rationally, and in advance what success looks like for this particular investment, and then to honor that decision even when every instinct in your body is screaming at you to stay. Think about how many times you or someone you know has watched a winning investment turn into a losing one because they held on too long. Think about the investors who watched a stock rise dramatically over months or even years, who had beautiful gains on paper, who then held through a correction and ended up worse off than if they had simply sold at a reasonable profit and moved on. This pattern is so common, it is almost universal among amateur investors. The Zurich Axioms say there is a better way, and the better way is to treat a predetermined target profit as a firm commitment to yourself, not a suggestion, not a guideline, but a binding decision that you honor without exception. The third axiom is about hope, and it may be the most emotionally challenging one of all, because hope is supposed to be a virtue. Hope is supposed to be the quality that gets us through difficult times, the belief that things will get better, the refusal to give up. And in life, that may indeed be a virtue. But in investing, the Zurich Axioms say, hope is a trap. The third axiom states, when the ship starts to sink, do not pray. Jump. What this means in practice is, when an investment starts going wrong, get out. Do not hope that it will turn around. Do not tell yourself that things will get better. Do not add more money in the hope of recovering your losses. Just get out. Take your loss. Cut it off clean and move on. This is, for most people, the hardest thing to do in all of investing. Because the moment you sell at a loss, you make it real. As long as you are still holding the investment, the loss is theoretical. It is on paper. It is not yet true. But the moment you sell, you have to face it. You have to acknowledge that you were wrong, that your judgment was off, that you lost money. And that is a profoundly uncomfortable thing to accept. The psychological pull to avoid this acceptance is enormous. It keeps people holding losing investments for months, sometimes years, sometimes long after the investment has become essentially worthless because they cannot bring themselves to make the loss real by selling. They convince themselves that if they hold long enough, the investment will eventually come back. And sometimes it does, but often it does not. And while they are waiting and hoping for a recovery that may never come, they are also giving up the opportunity to take whatever money they have left and put it to work somewhere more promising. The Zurich Axioms are ruthless on this point. They say, the moment you notice that something is going wrong, that is the moment to act. Not the moment to pray, not the moment to consult advisors, not the moment to seek reassurance or look for reasons why things might improve. The moment to act. Because the ship that is sinking rarely stops sinking in time to save you if you wait too long. There is a minor axiom connected to the third major axiom, and it says, accept small losses cheerfully as a cost of doing business. Do not expect to be right all the time. This is a mindset shift of enormous importance. The successful speculator does not aim to be right every time. That is an impossible standard. Even the greatest investors in history have had investments that went wrong. What separates them from the average investor is not that they avoid losses, but that when losses occur, they are small because they act quickly. They do not let small losses become large ones. They do not hold and hope. They cut and move. Think of it like running a business. Every business has expenses. Some of those expenses are investments in things that pay off, and some are investments in things that do not. The business owner who survives and thrives is not the one who somehow manages to never make a bad investment. That person does not exist. The one who survives and thrives is the one who recognizes bad investments quickly, stops throwing good money after them, and moves on. In the same way, the successful speculator treats losses as a cost of doing business, as something that will inevitably happen from time to time, and the skill lies not in avoiding them, but in keeping them small. Now we come to the fourth axiom, which is perhaps the most intellectually liberating of all 12, because it frees you from one of the most persistent and expensive delusions in all of investing. The fourth axiom is about forecasts, and it states, human behavior cannot be predicted. Distrust anyone who claims to know the future, however dimly. This is a statement about the fundamental nature of markets and the fundamental limits of human knowledge. Markets are not machines. They are not systems that operate according to fixed, predictable rules. They are the collective expression of the decisions of millions of individual human beings, each of whom is responding to their own unique set of information, emotions, fears, hopes, and miscalculations. The result is a system of almost incomprehensible complexity, one that cannot be reliably modeled or predicted, no matter how sophisticated the analytical tools, no matter how much historical data is available, no matter how intelligent the analysts involved. And yet, the financial industry is built almost entirely on the business of forecasting. Economic forecasters predict where the economy is going. Stock analysts predict which companies will outperform. Currency traders predict which direction exchange rates will move. Central bankers predict where inflation and employment are headed. And all of these predictions, despite the enormous resources devoted to making them, are wrong a startlingly large proportion of the time. Max Gunther documented this in detail. He looked at the track records of professional forecasters in various fields, from meteorology to economics to stock market analysis, and what he found was sobering. Even in fields where the underlying science is well developed and the data is abundant, prediction accuracy over meaningful time horizons is barely better than chance. And in the inherently human, emotionally driven world of financial markets, it is often no better than random. So what does this mean for the investor? It means you should stop looking for the perfect forecast. It means you should stop paying for investment newsletters that promise to tell you which stocks will rise this year. It means you should stop treating the confident predictions of television experts as useful information. It means you should make your financial decisions based on what is actually happening right now, not on what someone thinks might happen in the future. The minor axiom connected to the fourth major axiom says, never confuse a forecast with a fact. This is a distinction that sounds obvious, but is violated constantly in practice. When a respected economist says that growth will slow in the next 12 months, that is not a fact. It is a guess, however informed. When a bank analyst says that a particular stock will reach a certain price within the next year, that is not a fact. It is an estimate based on a model built on assumptions, any one of which could be wrong. Treating such estimates as facts is one of the most expensive mistakes an investor can make. The Zurich approach says use forecasts as one input among many, not as the basis for your decisions. Gather information. Think carefully. Make your best judgment in the present moment, and then stay alert, because the future has a habit of being nothing like what anyone predicted. The fifth axiom moves into territory that might initially seem abstract or philosophical, but which has very practical implications for investors. The fifth axiom is about patterns, and it states, chaos is not dangerous until it begins to look orderly. This axiom addresses one of the deepest and most persistent tendencies of the human mind, which is the tendency to see patterns where none actually exist. Our brains are pattern recognition machines. We evolved to find order in our environment, to notice regularities and repetitions and connections, because in the context of our ancestral environment, that ability helped us survive. If you learned that certain plants were toxic, or that certain predators hunted at certain times, recognizing those patterns could save your life. But in financial markets, this deeply ingrained tendency to find patterns leads us badly astray. We look at a chart of a stock price, and we see a pattern, a head and shoulders formation, a double bottom, a moving average crossover, and we become convinced that this pattern is telling us something reliable about the future. We look at a sequence of rising prices, and our brain tells us that the trend is our friend, that what has been happening will continue happening, that the pattern we see is real and meaningful and predictive. The Zurich Axioms say, be extremely careful here. Most of the patterns you see in financial data are not real. They are phantoms, artifacts of the randomness that underlies market behavior, shapes that your pattern-seeking mind has imposed on essentially random noise. The fact that a stock has risen for the past 10 trading sessions does not mean it will rise on the 11th. The fact that a market has historically performed well in the months of January and October does not mean you can rely on those patterns to repeat in the future. There is a specific and very important application of this axiom to the practice of technical analysis, which is the use of chart patterns and historical price data to predict future price movements. The Zurich Axioms are deeply skeptical of this approach. They do not say that chart reading is entirely worthless. They say, be aware that charts are a record of the past, not a window into the future, and that the patterns you see in them are far less reliable than they appear. The minor axiom connected to the fifth major axiom says, beware the historian's trap. The historian's trap is the mistake of assuming that because something has happened before, it will happen again. Every market, every asset, every economic cycle is in some ways unique, shaped by the specific circumstances of its time and place. Applying patterns from one era to another, from one market to another, from one economic environment to another, is a hazardous business. The investors who lost fortunes in the housing market collapse of 2008 were in many cases victims of the historian's trap. They looked at decades of historical data showing that house prices in major metropolitan areas had never fallen on a national basis, and they concluded that they could not fall. That pattern, however well established historically, turned out to be no guarantee at all. Now, we come to the sixth axiom, which challenges another one of the most deeply held beliefs in conventional investment philosophy. The sixth axiom is about mobility, and it states, avoid putting down roots. They impede motion. In financial terms, this means avoid becoming too attached to any particular investment, any particular market, any particular strategy. The world changes. Markets change. What worked last year may not work this year. The investment that made you rich in one decade might destroy your wealth in the next. The speculator, who is committed to mobility, who remains willing to move quickly when circumstances change, is far better positioned than the one who has become emotionally or practically attached to a particular position and cannot bring themselves to leave it. This axiom runs directly against the conventional wisdom of long-term investing, which tells you to buy good companies and hold them forever. And to be fair, for a very long time horizons and very broadly diversified portfolios, that approach can work. But the Zurich Axioms were not written for the passive investor who is content with average market returns over a lifetime of saving. They were written for the speculator who wants to do better than average, who wants to actively participate in financial opportunity rather than passively waiting for the market to deliver whatever it delivers. For that person, mobility is not just a nice-to-have quality, it is essential. Because opportunities do not wait. Because the window during which a particular investment will perform well is often shorter than people think. Because the ability to act quickly when something is going right and to exit quickly when something is going wrong is one of the most valuable skills a speculator can develop. The minor axiom, connected to the sixth major axiom, says, do not become trapped in a non-winning situation out of stubbornness or an excessive feeling of loyalty. This is a warning about two very human qualities that can be devastating in an investment context. Stubbornness is the refusal to admit you were wrong. Loyalty is the extension of personal affection to financial instruments, which cannot and do not reciprocate that affection. You may have loved a company for years. You may have followed it, believed in it, admired its products and its leadership. But when its fortunes begin to decline, your love for it does not protect your investment. The company does not love you back. It has no obligation to recover just because you have been faithful to it. The Zurich Axioms say, when an investment stops working, leave it behind, regardless of how attached you have become to it. The seventh axiom moves into a territory that many serious investors consider suspect, the territory of intuition. The seventh axiom states, a hunch can be trusted if it can be explained. This is a nuanced and carefully qualified position. The Zurich Axioms are not advocating blind gut-feeling investing. They are not saying you should make financial decisions based on mysterious inner voices or unexplained feelings. What they are saying is something more interesting and more sophisticated than that. Human intuition, when it is operating in a domain where you have genuine experience and knowledge, is often a form of rapid, unconscious pattern recognition. Your brain has been absorbing information about the market, about specific sectors, about economic conditions for years. It has developed a kind of background awareness that operates below the level of conscious thought. Sometimes, that background awareness produces a feeling, a sense that something is right or something is wrong, that you cannot immediately articulate or explain, but that is in fact rooted in real information and real experience. That kind of intuition, the kind that is grounded in genuine expertise, deserves to be taken seriously. But here is the key qualification embedded in the seventh axiom. If you cannot explain your hunch, if you cannot identify the underlying reasons for it, even imperfectly, even tentatively, then you should not trust it. Because in that case, it is not genuine intuition grounded in experience and knowledge. It may just be a feeling, a mood, a bias, a wishful thought, dressed up as insight. And acting on that kind of ungrounded feeling is not investing. It is gambling. The minor axiom connected to the seventh major axiom says, never confuse a hunch with a hope. This is one of the most practically useful distinctions in the entire book. Hope, as we discussed when covering the third axiom, is a dangerous emotional state in the investment context. It is the feeling you have when things are going wrong and you want them to go right. It is the wishful thinking that disguises itself as confidence or intuition or insight. A hunch that you cannot explain is often not a hunch at all. It is a hope. It is the feeling you want to have dressed up as the intuition you think you should trust. Learning to tell the difference between these two things is a skill that can save you an enormous amount of money. The eighth axiom takes us into territory that might seem strange in a financial context, but which turns out to be deeply relevant. The eighth axiom is about religion and the occult, and it states, "It is unlikely that God's plan for the universe includes making you rich." What does religion have to do with investing? More than you might think. The Zurich Axioms are addressing a very common and very damaging tendency among investors, which is the tendency to believe that the universe, or fate, or some higher power, has a special plan for them. The tendency to believe that their investments will succeed, not because of careful research and disciplined decision-making, but because things are meant to work out for them. The tendency to seek guidance from astrology, numerology, lucky numbers, market indicators, based on sunspot cycles, and various other forms of magical thinking when they are trying to decide what to do with their money. Max Gunther observed that even sophisticated, educated investors often have a quiet, private belief in luck or fate, or some kind of cosmic favoritism. They carry lucky charms. They make decisions based on superstitions. They consult horoscopes, and when they lose money, they tell themselves that they had bad luck, rather than examining the real causes of their loss. The Zurich Axioms say, dispense with all of this. The universe does not owe you prosperity. Fate is not on your side or against your side. There is no magical system, no lucky number, no mystical indicator that can reliably predict market movements. The financial world operates on cause and effect, on supply and demand, on the collective behavior of human beings, making decisions based on information, emotion, and self-interest. There is no divine intervention in that process. To believe otherwise is not just intellectually mistaken, it is financially dangerous, because it leads you to make decisions based on nonsense instead of reality. The minor axiom connected to the eighth major axiom says, if astrology worked, all astrologers would be rich. This is simple and devastating logic, and it applies far beyond astrology. It applies to every system, every method, every indicator that claims to predict the future of financial markets with supernatural or near supernatural reliability. If such a system actually worked, the people using it would quickly become the richest people in the world. The fact that they are not should tell you something very important. The ninth axiom deals with a distinction that is subtle but enormously important, the distinction between optimism and confidence. The ninth axiom states, optimism means expecting the best, but confidence means knowing how to handle the worst. Never make a move if you are merely optimistic. Optimism is a valuable quality in many areas of life, but in investing, pure optimism, the belief that things will work out simply because you want them to, is not a strategy, it is a feeling. And feelings, as we have seen throughout the Zurich Axioms, are not reliable guides to financial decision-making. What the Zurich Axioms demand instead is confidence. And confidence here means something very specific. It means knowing what your plan is if things go wrong. It means having thought through the downside scenario as carefully as the upside one. It means being able to say, if this investment fails, here is what I will do. Here is the maximum I am prepared to lose. Here is my exit strategy, and I am at peace with that outcome. The difference between an optimistic investor and a confident one is visible in their behavior when things start to go wrong. The optimistic investor hopes for a turnaround and does nothing. The confident investor executes their pre-planned exit strategy without hesitation because they already knew this was a possibility and they already decided what they would do about it. The confident investor has done the emotional and mental work in advance. The optimistic investor has not, and when reality diverges from their hopes, they are caught flat-footed. There is a minor axiom attached to the ninth major axiom, and it says, never make a move unless you have first made sure that the potential loss is acceptable to you. This is a pre-investment discipline that the most successful speculators practice consistently. Before entering any position, before committing any capital to any opportunity, they ask themselves, what is the worst that can happen here? What is the most I could lose? And can I genuinely live with that outcome? If the answer to that last question is yes, they proceed. If the answer is no, they do not. This sounds simple. In practice, it requires a degree of honesty with yourself that most people find genuinely difficult. Because when an opportunity looks exciting and promising, the temptation is to focus exclusively on the upside. You want to think about how much you might gain, not about how much you might lose. The discipline of forcing yourself to confront the downside honestly before you commit is one of the habits that most consistently separates successful speculators from unsuccessful ones. The 10th axiom is one that will resonate with anyone who has ever watched a financial bubble inflate and then pop. The 10th axiom is about consensus, and it states, disregard the majority opinion. It is probably wrong. This is a statement about the nature of markets and the nature of crowds. In many areas of life, the majority opinion is a useful guide. If most people think a restaurant is good, it probably is. If most people think a neighborhood is safe, it probably is. The aggregation of individual opinions and experiences tends to produce useful collective wisdom in contexts where the information is broadly distributed and the question is fundamentally about preferences or observations. But financial markets are different in a very important way. In financial markets, when the majority of people agree that a particular investment is excellent, they have already bought it. The price already reflects their enthusiasm. And if everyone who wants to buy has already bought, the only way the price can go from that point is down. The investment that everyone agrees is wonderful has already had its great performance. You are not getting in at the beginning of a trend when you follow the consensus. You are getting in at the end of it. Conversely, the investment that most people consider terrible, risky, or hopeless, the one that financial commentators are warning people away from, is often priced to reflect all of that pessimism. It is cheap precisely because everyone has given up on it. And that cheapness means that if anything changes, if any catalyst causes people to reconsider, the price does not have far to rise to generate significant gains. The great fortunes in financial history have almost always been made by contrarians, by people who had the courage and the insight to do the opposite of what the crowd was doing. This does not mean being contrarian for its own sake, refusing to follow any consensus simply out of perversity. It means developing the independence of thought to evaluate situations on their own merits, rather than simply going along with the prevailing opinion. The minor axiom connected to the 10th major axiom says, if the majority of people agree that something is true, examine it very carefully before you accept it. This is a principle of intellectual independence that extends beyond finance into every area of life. Consensus can be comfortable. It is easier to agree with the crowd than to stand apart from it. But in investing, comfort and profitability are often in tension. The comfortable position is usually the fully priced one. The profitable position is usually the uncomfortable one, the one that requires you to believe something that most people do not yet believe, to see something that most people have not yet seen. Developing this capacity for independent judgment is not easy. It requires practice, discipline, and a certain tolerance for being wrong sometimes, because not every contrarian bet pays off. But the rewards of developing it are substantial, because the biggest gains available in any market are found precisely in the places where the consensus has not yet arrived. Now we arrive at the 11th axiom, which addresses a quality that sounds admirable, but which the Zurich Axioms identify as financially dangerous. The 11th axiom is about stubbornness, and it states, if it does not pay off the first time, forget it. This runs directly against one of the most popular pieces of folk wisdom in the investing world, which is that persistence is the key to success, that if at first you do not succeed, you should try again. And in many areas of human endeavor, that advice is sound. Learning a new skill, building a business, developing a relationship, these are all areas where persistence and the willingness to fail, learn, and try again are genuinely valuable. But in investing, the 11th axiom identifies a particular trap that persistent thinking can lead you into. The trap works like this. You invest in something. It does not work. You become convinced that you were right and the market was wrong. You double down, putting more money into the same position. It still does not work. You tell yourself it is just a matter of timing, that the market will eventually recognize the value you see. You add more. And gradually, what began as a calculated bet becomes an obsession, a crusade, a matter of personal pride, and an ever-increasing financial commitment to something that simply is not working. The Zurich Axioms say, this is a trap, and the way to avoid it is to set a clear decision rule in advance. If something does not work, you do not reflexively repeat it. You accept that your thesis was wrong, or that the timing was wrong, or that circumstances have changed in ways that invalidate your original assessment, and you move on. This does not mean abandoning every investment the first time it experiences a setback. It means distinguishing between a temporary difficulty in an otherwise sound investment and a fundamental flaw in your investment thesis. If the reasons you made the investment are still valid, if the underlying story has not changed, a temporary price decline is not a reason to exit. But if the investment is simply not performing and you find yourself looking for new reasons to stay in, new justifications for holding on, that is a warning sign that you may be caught in the trap of stubbornness. The minor axiom, connected to the 11th major axiom, says, do not try to save a bad investment by averaging down. Averaging down is the practice of buying more of an investment as its price falls, so that the average purchase price you have paid becomes lower. In theory, this means that when the price eventually recovers, you will profit more because you bought more at the lower price. In practice, this approach is one of the most reliable ways for investors to turn a small loss into a catastrophic one. Here is why. When a price is falling, there is usually a reason. Maybe the underlying business is deteriorating. Maybe industry conditions have changed. Maybe the entire sector is in trouble. When you average down, you are doubling your bet on a situation that is already going against you, based on the hope that your original thesis was right and that the market will eventually come around. But markets can stay wrong far longer than investors can stay solvent. And if the price keeps falling, each additional purchase just means you lose even more when you finally accept defeat. The Zurich Axioms say, when an investment is going the wrong way, the right response is not to add more money. The right response is to examine your thesis honestly, and if it is no longer valid, to exit cleanly. The 12th and final major axiom is in some ways the most radical of all, because it attacks something that virtually everyone considers a fundamental pillar of financial responsibility. The 12th axiom is about planning, and it states, long-range plans engender the dangerous belief that the future is under control. Never make a long-range plan. Let that settle in for a moment. Never make a long-range plan. In a financial culture that is built almost entirely on the concept of long-range planning, on retirement planning, on 5-year investment strategies, on portfolio allocations designed for a 20-year time horizon, this axiom sounds almost irresponsible. And yet, when you understand the reasoning behind it, it makes profound sense. The problem with long-range plans is not that thinking about the future is bad. The problem is the psychological effect that making a plan has on the way you respond to new information. Once you have a plan, you become invested in it. You have spent time and energy creating it. You may have shared it with others and committed to it publicly. You have developed an emotional attachment to it. And when new information arrives that suggests the plan is no longer appropriate, you tend to resist that information. You rationalize it away. You tell yourself that the plan is still sound and that the new information is just noise. You do not update your strategy because doing so would mean admitting that your plan was wrong, and you do not want to do that. This is what the Zurich Axioms mean when they say that long-range plans engender the dangerous belief that the future is under control. The plan does not put the future under control. Nothing can put the future under control. But the plan creates the illusion that it is, and that illusion makes you less responsive to reality, less willing to adapt, less capable of the mobility that the sixth axiom identified as essential. What the Zurich Axioms advocate instead is not the absence of thought about the future, but a different relationship to the future. Instead of a rigid long-range plan, you have goals and you have values. You know what you want. You know what kind of life you are trying to build, what kind of financial security you are seeking, what level of wealth would give you the freedom and the options you want. Those are not plans. Those are intentions. And the difference between an intention and a plan is that an intention keeps your eyes open to multiple possible paths to the same destination, while a plan can blind you to any path that was not the one you originally envisioned. The minor axiom connected to the 12th major axiom says, never put yourself in a position from which you cannot retreat. This is a principle of strategic flexibility that applies not just to individual investment decisions, but to your entire financial structure. It means never committing yourself so completely to any single investment, strategy, or financial arrangement that you lose the ability to change course if circumstances require it. It means maintaining enough liquidity, enough optionality, enough freedom of movement that you can respond to what is actually happening rather than being locked into what you planned was going to happen. It is worth expanding on each of these axioms with the real-world context that makes them so powerful and so enduringly relevant, because these principles did not emerge from a classroom or a library. They emerged from the lived experience of people who had operated at the sharp end of financial markets for decades, and that experience has a texture and a weight that purely theoretical principles lack. Let us return to the first axiom and explore it more deeply. The relationship between risk and reward is the most fundamental relationship in all of finance. It is not an opinion or a school of thought. It is a structural feature of how markets work. Investors who are willing to take on more uncertainty, more possibility of loss, must be compensated with a higher expected return, because otherwise, no rational person would take on that additional uncertainty. This compensation takes the form of higher expected prices, higher expected dividends, higher expected interest payments. The more you risk, the more you can potentially earn. This means that the investor who successfully manages risk, who is disciplined and knowledgeable enough to take on calculated risk without being reckless, has a structural advantage over the investor who avoids risk entirely. The risk avoider is not safe. The risk avoider is simply accepting a low, almost certainly inadequate return in exchange for the illusion of security. Because no investment is truly risk-free. Even the most conservative approach, keeping your money in cash or in the safest government instruments available, carries the risk that the purchasing power of that money will be slowly eroded over time. The risk does not disappear when you avoid speculative investments. It just takes a different, slower, less visible form. And here is something important about the nature of worry that the first axiom captures so well. Worry, genuine engaged worry about the outcome of a financial position, is actually a productive state. It keeps you paying attention. It keeps you reading, researching, monitoring, thinking. The investor who is not worried is the investor who has tuned out, who has put their money somewhere and stopped thinking about it, trusting that some unnamed force will take care of things. That investor is not safe. They are just asleep. And asleep investors get hurt badly when reality intrudes, as it always eventually does. Let us revisit the second axiom on greed with a concrete illustration that brings its importance to life. Consider what happens in a speculative bubble. A new technology emerges, or a new asset class attracts attention, or a particular sector starts performing well. Early investors see their positions rise, slowly at first, then more quickly. Others notice and want in. They buy, pushing prices higher. The rising prices attract more buyers, who push prices higher still. By the time the bubble is fully inflated, there is a strong consensus that this particular investment cannot fail, that the trend will continue indefinitely, that this time really is different. At this point, the smart investor who has followed the second axiom has already sold. They decided in advance what return would satisfy them. They reached that return, and they got out. They are now watching from the sidelines as the bubble continues to inflate. And for a while, they feel foolish. They see people who stayed in continuing to make money. They hear friends and colleagues talking about how much they have made. The temptation to go back in is intense, but the discipline of the second axiom holds. And then the bubble bursts. It always does. And the people who held on, who could not bring themselves to take their profit because they were sure there was more to come, watch their gains evaporate. In the worst cases, they end up below where they started. The early investor who followed the second axiom walks away with a solid, real, banked profit. Not the maximum possible profit, because they sold before the peak, but a real profit, a kept profit, a profit that actually exists in their account rather than in a memory of what their portfolio used to be worth. The difference between a paper profit and a realized profit is one of the most important distinctions in all of investing. A paper profit is what your portfolio says you have made. A realized profit is what you have actually put in your pocket. The second axiom of the Zurich system says, prioritize the realized profit over the paper one. The paper one can disappear. The realized one cannot. Let us go deeper into the third axiom and the psychology of loss, because this is where most investors do the most damage to themselves. The human mind has what psychologists call loss aversion, which is the tendency to feel the pain of a loss much more intensely than the pleasure of an equivalent gain. Studies in behavioral economics have shown that the pain of losing a sum of money is approximately twice as intense as the pleasure of gaining the same sum. This means that people will go to enormous lengths to avoid realizing a loss, because the act of realizing it, of selling the losing investment and booking the loss, feels psychologically devastating in a way that a mere paper loss does not. This is why investors hold losing positions for so long. It is not irrational in the sense of being incomprehensible. It is completely understandable given how the human mind works. But it is financially devastating because while you are waiting for a losing investment to recover, you are not just losing the money you have already lost. You are also giving up the opportunity to take whatever money remains and put it to work in something that might actually perform. This is what economists call an opportunity cost, and it is one of the most significant but least visible sources of investment underperformance. The Zurich approach cuts through this psychological trap with a single brutal principle. When the ship is sinking, jump. Do not wait to see if it will stop sinking. Do not consult advisors or look for reassurance. Do not hope. Act. Exit the position, take the loss, and move on. The freedom that comes from this discipline is remarkable. Once you have internalized the principle that losses are a normal cost of doing business, once you have released yourself from the psychological obligation to be right every time, you find that decision-making becomes much clearer and much faster. You are no longer burdened by the weight of positions that are not working. You are free to move toward what is working, toward what the market is actually rewarding right now, rather than being anchored to the past and to your original thesis. On the fourth axiom about forecasts, it is worth dwelling on the specific and systematic ways in which professional forecasters get things wrong, because understanding the mechanisms of forecasting failure helps you understand why the Zurich Axioms are so skeptical of predictions. One of the most consistent patterns in forecasting failure is what researchers call anchoring. When a forecaster makes a prediction, they start from a current reference point and adjust from there. If a stock is currently trading at a certain level, analysts tend to predict future prices that are relatively close to that current level, because the current level is their anchor. The problem is that real markets can move far more dramatically than the range that anchoring naturally produces. The analyst who is anchored to the current price will consistently underestimate the magnitude of both gains and losses. Another consistent failure mode in forecasting is the herding behavior that affects even professional analysts. If the consensus among economic forecasters is that growth will be moderate next year, an individual analyst who departs significantly from that consensus faces professional risk. If they turn out to be wrong, they will have been conspicuously, embarrassingly wrong in a direction that the majority correctly rejected. If they stick with the consensus and turn out to be wrong, at least they were wrong along with everyone else, which is much more professionally survivable. This asymmetry of professional risk pushes forecasters toward the comfort of the crowd, which means that official forecasts tend to cluster together and to systematically understate the probability of dramatic outcomes. The practical implication for the investor is clear. When forecasters all agree that a particular outcome is likely, be especially skeptical. The forecasters may be right, but they may also simply be following each other into the same wrong answer, and the cost of that wrong answer is borne by the investors who trusted them. The fifth axiom about patterns has particularly important implications for the large and growing population of investors who use technical analysis as their primary guide to market timing. Technical analysis is the study of historical price charts and trading volume data to identify patterns that are believed to predict future price movements. It is a vast field with a long history and a very large number of practitioners, many of whom are genuinely sophisticated and intellectually serious people. The Zurich Axioms do not dismiss technical analysis entirely. What they say is be very, very careful about the degree of confidence you place in the patterns you observe in price data. The human brain is extraordinarily good at seeing patterns in data, even when those patterns are not statistically meaningful. We can see faces in clouds, animals in rock formations, and trends in data that is purely random. When you look at enough charts, you will inevitably see patterns that look significant and meaningful. But looking significant and being meaningful are very different things. The deeper issue is that even patterns that have been historically valid can stop working at any time, often precisely because enough investors have noticed them and started trading on them. When a pattern becomes widely known, the smart money starts anticipating it, buying before the pattern completes and selling before the usual follow-through happens. This destroys the profitability of the pattern for later traders, and over time, it can cause the pattern itself to disappear from the data. The sixth axiom about mobility takes on particular importance in periods of rapid structural change in the economy. We live in an era when entire industries can be disrupted and rendered obsolete by new technologies in a matter of years. The business models that seemed unassailably strong a decade ago can be under severe pressure today. The geographical markets that offered the best opportunities 5 years ago may offer very limited opportunities now, while entirely new markets have emerged that did not exist then. The investor who has put down roots, who has developed deep knowledge of and strong positions in a particular sector or geography, faces a real danger when that sector or geography goes through a structural decline. They have to overcome not just the financial cost of moving, but also the psychological cost of abandoning expertise they have spent years developing, relationships they have cultivated, and beliefs they have built their investment approach around. The Zurich Axioms say, this is not a reason to stay. Your expertise is valuable, but it is not more valuable than your financial future. If your roots are holding you in a place that is no longer productive, you have to pull them up. You have to be willing to learn new things, enter new territories, develop new expertise, because the alternative is to be tied to a declining position by the weight of your own history and habits. On the seventh axiom about intuition, it is worth exploring in more depth what genuine financial intuition looks like and how it develops. The kind of intuition that the Zurich Axioms endorse is not a mystical gift. It is accumulated experience, carefully processed, It is the result of years of paying close attention to markets, to industries, to economic cycles, to the behavior of companies and their competitors. Over time, this accumulated attention produces a kind of background knowledge that operates below the level of conscious thought, but that can surface as a feeling, a sense of rightness or wrongness about a particular opportunity. The investor who has followed a particular industry for 20 years has absorbed an enormous amount of information about how that industry works, about what factors tend to drive its cycles, about the kinds of companies that succeed and fail in that environment. When they look at a new opportunity in that industry and feel that something is off, even before they can articulate exactly what, that feeling deserves respect. It may be that their unconscious mind has already processed several warning signs that their conscious mind has not yet had time to identify. But, and the seventh axiom is very clear on this, the ability to develop a genuine, experience-based, explainable intuition takes time. It takes years. And it is domain-specific. Your intuition about the retail sector may be highly reliable, developed over decades of attention, while your intuition about cryptocurrency or biotechnology, domains where you have far less experience, is worth much less. The seventh axiom is not a license to follow every feeling. It is a call to develop, over time, the kind of deep domain knowledge that makes genuine intuition possible. The eighth axiom about religion and the occult touches on something that investors rarely discuss openly, but that exerts a significant influence on financial behavior. The belief in luck, in fate, in supernatural guidance of some kind, is more prevalent among investors than most would admit in a professional context. And it expresses itself in ways that range from the clearly irrational, like consulting horoscopes or using numerology to choose stocks, to the subtly irrational, like believing that a run of good fortune is a sign of special status or divine favor. Max Gunther was particularly interested in what he called the gambler's fallacy variant in investing, which is the belief that a run of good luck is somehow owed to you, that the universe has been keeping score, and now it is your turn to win. This belief can lead investors to take progressively larger and less justified risks after a period of success on the grounds that they are on a winning streak and the universe will not let them down. It can also lead investors to take desperate, poorly thought out risks after a period of losses on the grounds that they are due for a win and their luck must eventually turn. Neither of these beliefs has any basis in financial reality. The market does not know your history. It does not know that you have had a difficult 6 months and are overdue for a good run. It does not know that you have been on a winning streak and deserve to have it continue. It is simply the aggregate of millions of independent decisions made by people and institutions all around the world, none of whom are taking your personal situation into account. Decisions made on the basis of what you are owed or what the universe has planned for you are not investment decisions. They are superstitions, and superstitions in the financial world are paid for with real money. Expanding on the ninth axiom about optimism and confidence reveals one of the most important psychological skills an investor can develop, which is the skill of realistic assessment in the presence of hope. Hope is natural. Hope is human. When you put money into an investment, you want it to work. You want it to succeed. You are emotionally invested in the outcome in a way that makes purely dispassionate evaluation very difficult. The ninth axiom does not ask you to eliminate hope. It asks you to supplement it with preparation for failure. Confident speculation, in the Zurich sense, looks like this. Before you enter a position, you ask yourself, what would it look like if this goes wrong? You identify the specific signals that would tell you your thesis has failed. You set the level of loss at which you will exit, not based on emotion, not based on how the loss will feel, but based on a cold-eyed assessment of what outcome would indicate that you were wrong. You decide in advance what you will do if that signal appears, and then you commit to honoring that decision. This is the opposite of blind optimism. It is a disciplined engagement with risk that allows you to participate in upside opportunities while limiting the damage when things go wrong. It is what separates the investor who survives in the long run from the one who eventually gets wiped out by a single bad bet they could not bring themselves to exit. The 10th axiom, about consensus, has a fascinating historical dimension that makes it particularly compelling. Every major financial bubble in history, from the tulip mania of the 17th century to the internet bubble of the late 20th century, from the South Sea Company to the housing market of the early 21st century, has been characterized by a consensus that this particular investment is different, that normal rules do not apply, that the price can keep rising because this time the fundamentals genuinely support it. And in every case, the investors who made real money were not the ones who embraced the consensus at its peak. They were the ones who got in early, before the consensus formed, when the opportunity was still considered strange or risky or unclear. And sometimes they were the ones who sold short into the bubble, the ones who bet against the consensus at its most enthusiastic point, accepting the social cost of being the voice saying that the emperor has no clothes. Being a contrarian is not comfortable. When everyone around you is making money on something you are not invested in, the pressure to conform is immense. When you are betting against a rising market, the psychological cost of watching prices continue to rise against you, at least temporarily, is severe. The 10th axiom asks you to develop the kind of intellectual independence and emotional resilience that allows you to maintain a position that is opposed to the majority view, based on your own analysis, for as long as that analysis remains valid. This does not mean being permanently contrarian, reflexively rejecting every popular investment. It means doing your own work, forming your own views, and having the confidence to act on those views even when they diverge from the consensus. It means asking, not what does everyone else think about this, but what do I think about this, based on the available evidence, and is my thinking sound? The 11th axiom about stubbornness connects deeply to one of the most well-documented phenomena in behavioral finance, which is the disposition effect. The disposition effect is the observed tendency among investors to sell winning investments too quickly and hold losing investments too long. Investors take profits early because it feels good to lock in a win, and they hold losses because realizing them feels bad. The result is that the average investor ends up with a portfolio skewed toward their losers because they have sold their winners but are still holding on to everything that has gone wrong. The 11th axiom is a direct corrective to this tendency. It says, reverse the natural impulse. Let your winners run until your predetermined target is reached, as instructed by the second axiom, and cut your losers quickly, as instructed by the third axiom. And if an investment repeatedly fails to perform when you try it, stop trying. The stubbornness that keeps you going back to the same well that has been dry every time is not perseverance. It is a form of magical thinking, the belief that if you do the same thing enough times, the outcome will eventually change. There is an important distinction to draw here between stubbornness about an investment and stubbornness about a broader strategy. The 11th axiom is about not repeating specific failed investments. It is not about abandoning a disciplined approach to investing just because it has not produced immediate results. The Zurich Axioms as a whole represent a strategy, and like any strategy, they need time to demonstrate their value. But within that strategy, individual investments that fail to perform should be let go without guilt or regret, because holding on to them is a form of throwing good money after bad. The 12th axiom about planning connects to a deep insight about the nature of uncertainty that philosophers and scientists have grappled with for centuries. The world is a complex, interconnected dynamic system in which every action produces ripples that spread outward in directions that cannot be fully predicted. The financial world is embedded in this larger system and shares its fundamental unpredictability. Any plan that extends far into the future is built on the assumption that the conditions of today will persist more or less, into the future. But they will not. They never do. The history of financial markets is full of examples of plans that were made in one environment and then became completely inappropriate when the environment changed. The investor who planned for inflation ended up overweight in inflation hedges when deflation arrived. The investor who planned for rising interest rates held short-duration bonds when rates fell for a generation. The investor who planned for continued growth in emerging markets held those positions through a decade of underperformance. In each case, the plan was not wrong based on the information available when it was made, but the world changed, and the plan did not. What the Zurich Axioms advocate, instead of long-range planning, is ongoing, active engagement with current reality. Rather than setting a course for the next 20 years and sticking to it, you stay flexible. You have goals, as we noted, but you hold your strategies lightly, ready to revise them as new information arrives. You are not surprised when the world turns out differently from your expectations, because you were never attached to a specific prediction of what the world would be like. You are simply looking at what the world actually is, right now, and making the best decision you can based on that reality. This approach requires a kind of intellectual humility that is genuinely hard to develop. It requires you to accept that you do not know what will happen next, that no one does, that certainty is not available to you or to anyone, and that the appropriate response to that uncertainty is not to deny it with an elaborate plan, but to remain agile in the face of it. Now, having walked through all 12 of the major axioms and their associated minor axioms, it is worth stepping back and looking at the picture they paint together. Because the Zurich Axioms are not just a collection of individual tips or tactics, they represent a coherent philosophy of engaging with financial uncertainty, a philosophy that is radically different from the conventional wisdom that dominates most financial advice. The conventional wisdom says, reduce risk through diversification. The Zurich Axioms say, take on meaningful, concentrated risk because that is the only path to meaningful reward. The conventional wisdom says, be patient and hold through downturns. The Zurich Axioms say, cut your losses quickly and do not hope for recoveries. The conventional wisdom says, trust the experts and follow the consensus. The Zurich Axioms say, think for yourself and be skeptical of any consensus. The conventional wisdom says, make a long-term plan and stick to it. The Zurich Axioms say, stay flexible and never let a plan blind you to current reality. The conventional wisdom says, be optimistic and believe in the future. The Zurich Axioms say, be confident rather than optimistic, which means preparing for the worst while working toward the best. These are not small differences in emphasis or degree. They are fundamental divergences in philosophy. And the question you naturally ask is, which philosophy is right? The answer that the Zurich Axioms implicitly offer is this. The conventional wisdom is designed for the average investor, for the person who is not actively engaged in speculating, who is simply saving money and putting it in broadly diversified instruments for the long term. For that person, in that context, the conventional wisdom is not unreasonable. Long-term, diversified, patient investing does produce positive returns over sufficiently long time horizons, and it does so with a level of simplicity and predictability that many people find appropriate for their situation. But the Zurich Axioms are not written for that person. They are written for the speculator, for the person who wants to actively engage with financial markets, who wants to do better than average, who is willing to put in the work, take on the risk, and develop the discipline required to play the game at a higher level. For that person, the conventional wisdom is not just insufficient. It can be actively harmful because it encourages a passive, trusting, emotionally comfortable approach to markets that will not produce the results that an active speculator is seeking. The speculator's edge, when it exists, comes from doing things differently from the majority. It comes from being willing to take risks that others avoid, from cutting losses that others would hold, from taking profits that others would leave on the table, from going against consensus when your analysis suggests the consensus is wrong, and from moving on when others are stubbornly persisting in failed strategies. The Zurich Axioms provide the intellectual and psychological framework for doing all of those things with discipline and consistency. There is also a broader life philosophy embedded in the Zurich Axioms that extends beyond the purely financial. It is a philosophy of engagement with uncertainty, of honest acceptance of the limits of knowledge, and of disciplined action in the face of that uncertainty. In a world that often tries to sell us the illusion of certainty, whether through confident experts, through elaborate plans, through historical patterns, or through superstitious beliefs, the Zurich Axioms offer a different and more honest message. They say, uncertainty is the water you swim in, and the question is not how to make it go away, but how to navigate it well. Max Gunther himself was clear that the Zurich Axioms are not a system that guarantees success. They are a set of principles that improve the odds of success while limiting the consequences of failure. Even the most disciplined practitioner of these principles will have investments that go wrong. They will miss gains by selling too soon. They will cut positions that would have recovered. They will stand against consensuses that were actually right. The axioms are not about being right every time. They are about being right often enough and handling the wrong times well enough to come out ahead in the long run. This is a more realistic and more honest promise than most investment advice offers. Most investment advice implicitly promises that if you follow the right system, you will consistently make money. The Zurich Axioms make no such promise. They acknowledge that markets are uncertain, that losses are inevitable, and that the best you can do is manage your behavior in a way that stacks the odds in your favor over time. That is a more modest promise. But it is also a more honest one. And in the world of investing, honesty about the nature of risk and uncertainty is worth more than any number of optimistic but ultimately false guarantees. Let us also consider the cultural and historical context from which the Zurich Axioms emerged, because that context helps explain why they have the particular character they do. The Swiss speculators who developed these principles were operating in the specific environment of 20th century Europe, an environment marked by extreme instability, by the collapse of empires and currencies, by two devastating world wars, and by periodic economic catastrophes of a severity that most contemporary investors in stable Western countries have never experienced. In that environment, the complacent long-term investor was not just underperforming, they were being wiped out. Currencies collapsed, governments seized assets, borders changed, companies and entire industries disappeared almost overnight. The investor who had put down roots, who had made a long-range plan and was sticking to it, who trusted the consensus and the experts, who held on to losing investments and hoped for recovery, was devastated again and again by the brutal reality of a world that refused to behave according to plan. The investors who survived, and more than survived, who actually prospered through these upheavals, were the ones who stayed mobile, who moved quickly when conditions changed, who were willing to abandon any position, any strategy, any attachment when the facts required it. The Zurich Axioms are the distilled wisdom of people who had been tested by history at its most demanding and who had found a way through. That is what gives them their particular quality, their toughness, their refusal to offer comfort or false assurance, their insistence on clear-eyed engagement with reality as it is rather than as we would like it to be. The lesson, applied to the contemporary investor, is sobering and energizing at the same time. We live in a world that is less dramatically unstable than the Europe of the first half of the 20th century, but that is still characterized by uncertainty, change, and the potential for rapid and unexpected disruption. Markets can and do crash suddenly. Industries can and do face existential disruption from technology or regulation or changing consumer behavior. Currencies can and do weaken in ways that devastate the savings of people who held them. Governments can and do change policy in ways that fundamentally alter the investment landscape. These things are not extreme scenarios. They are part of the normal history of financial markets. The investor who approaches this environment with the discipline of the Zurich Axioms, who is willing to take meaningful risks with proper attention and planning, who takes profits when they are available, who cuts losses without hesitation, who thinks independently, who stays mobile and flexible, and who never mistakes a plan for a prophecy, is well equipped to navigate whatever the financial future brings. Not to predict it, not to control it, but to navigate it. Let us also address a question that often arises when people first encounter the Zurich Axioms, which is whether they conflict with the widely endorsed strategy of buy and hold investing in broad market index funds. This is a genuine and important question, and the answer is nuanced. For investors whose primary goal is to accumulate retirement savings over a working lifetime, who are not interested in actively speculating in individual securities or markets, and who are willing to accept average market returns minus fees in exchange for a disciplined, low-stress approach to wealth accumulation, index investing has a great deal to recommend it. The academic evidence strongly supports the idea that most active managers underperform their relevant index benchmarks over long time periods once fees are accounted for. So for the passive investor, the conventional wisdom of broad diversification, low costs, and patient long-term holding is probably the right approach. But that is not the person the Zurich Axioms are addressing. They are addressing the active speculator, the person who wants to identify specific opportunities, who wants to outperform the market, who is willing to put in the work and take on the additional risk that active speculation requires. For that person, the conventional wisdom of index investing is too passive, too diversified, and too much driven by hope in the long-term upward trend of markets to be the right framework. The Zurich Axioms and passive index investing are not in conflict because they are addressing different strategies for different investors with different goals and different temperaments. The key is to know which category you are in. If you are a passive investor who wants to save systematically for retirement without active engagement in market timing or stock selection, the Zurich Axioms may not be your primary guide. But if you are an active speculator who wants to engage directly with markets, who makes specific investment decisions rather than simply allocating to broad asset classes, then the Zurich Axioms offer some of the most practically useful and psychologically honest guidance available. It is also worth addressing the common objection that the Zurich Axioms encourage excessive short-term thinking, that by taking profits early, cutting losses quickly, and avoiding long-range plans, you lose the benefit of genuine long-term compounding. This objection has some merit when applied to passive, buy and hold investing in great businesses or broad market indices. But it misunderstands what the Zurich Axioms are advocating. The Zurich Axioms are not advocating for day trading or for constant churning of a portfolio. They are advocating for a mindset of engagement, flexibility, and willingness to act decisively when circumstances warrant. A speculator following the Zurich Axioms might hold a position for months or even years if it continues to perform and continues to align with their thesis. The key is not the length of time held, but the ongoing active monitoring and the willingness to exit without hesitation when the situation changes. The Zurich Axioms are also deeply compatible with genuine long-term thinking in one important sense. By cutting losses quickly, by not letting bad investments drain your capital for years, by taking profits and recycling them into new opportunities, the disciplined speculator keeps their capital actively working and growing. The investor who holds a losing investment for 3 years, waiting for a recovery that does not come, has not been a long-term investor in any meaningful sense. They have simply been a stubborn investor, and their 3 years of waiting have been 3 years of opportunity cost, 3 years during which their capital could have been working elsewhere. Real long-term wealth building, the Zurich Axioms suggest, comes not from holding any particular investment forever, but from maintaining a disciplined, active, and flexible approach to capital allocation over a long period of time. It is the discipline that persists, not the positions. The positions change as markets change, as opportunities shift, as the economic environment evolves. The discipline stays constant. Now let us think about how someone who is newly encountering the Zurich Axioms might actually begin to incorporate them into their investment approach. Because understanding the principles intellectually is one thing. Applying them under the pressure of real money at stake, in the midst of real market volatility, with real emotions running high, is quite another. The first step is to internalize the mindset shift that the first axiom requires. You need to become genuinely comfortable with the idea that risk is not your enemy, that worry is your friend and your guide, and that the pursuit of genuine financial growth requires you to put real money at stake in situations of genuine uncertainty. This mindset shift cannot happen overnight. It develops gradually as you take on more risk and learn, through experience, that you can handle the uncertainty without being destroyed by it. But it needs to begin with the intellectual commitment, the conscious decision to stop treating risk avoidance as the primary goal of financial management. The second step is to develop the habit of pre-investment planning that the second and third axioms require. Before you put money into any investment, ask yourself two questions. First, what return would satisfy me here? At what price would I say, I have done well with this investment and I am ready to move on? Second, what level of loss would tell me that my thesis was wrong? At what point would I say, I was mistaken and I need to exit this position? Write down the answers to both questions, commit to them, and then honor them when the time comes. The third step is to cultivate independence of thought, which is what the fourth and 10th axioms call for. Begin to pay attention to the quality of the analysis behind forecasts and consensus views, rather than simply accepting them because they come from authoritative-sounding sources. Ask yourself, what is the basis for this prediction? What evidence would change this view? What does the minority opinion say, and why? Developing this habit of questioning the official view is uncomfortable at first, because it means carrying the burden of your own analysis rather than outsourcing your decisions to experts. But it is one of the most important capabilities an active investor can develop. The fourth step is to practice mobility, which is what the 6th and 12th axioms call for. Each time you feel the pull of attachment to a particular investment, strategy, or plan, remind yourself that attachment is the enemy of performance. Remind yourself that the investment does not know you own it, does not care about your feelings toward it, and has no obligation to reward your loyalty. And remind yourself that the plan you made last year was based on a world that may have changed significantly since you made it, and that updating the plan is not a sign of weakness or inconsistency, but a sign of intelligence and adaptability. These are not easy things to do. They run against deeply ingrained habits and psychological tendencies that the human mind has developed over thousands of years. But with practice and with the right framework, they become easier over time. And the financial rewards of developing them, the losses avoided, the profits realized, the opportunities seized, can be substantial. There is also a community dimension to the Zurich Axioms that is worth acknowledging. The Swiss speculators who developed these principles did not operate in isolation. They shared their insights, their experiences, and their lessons with each other. They formed a community of practice, a group of people who held each other accountable to the principles they had agreed on, who helped each other maintain discipline when emotions ran high, and who contributed to the collective knowledge that eventually found its way into Max Gunther's writings. This suggests that one of the most valuable things an investor can do is find others who share a similar philosophy and engage with them regularly. Not for tips or predictions, which the fourth axiom has told us are generally unreliable, but for the accountability, perspective, and support that come from being part of a community of people who are all trying to practice the same discipline. When you are tempted to hold a losing investment too long, a community of fellow practitioners who understand the third axiom can help you see clearly. When you are tempted to follow the crowd into an investment that the consensus has already priced to perfection, someone who has internalized the 10th axiom can help you maintain your independent judgment. The Zurich Axioms also have something important to say about the role of information in investment decision-making. In an era of unprecedented information availability, when financial news, market data, analyst reports, company filings, and expert commentary are available in real time on every device, the temptation is to consume more and more information in the hope of finding the insight that will give you an edge. But the Zurich Axioms suggest a different relationship to information. More information does not necessarily produce better decisions. In fact, research in cognitive science and decision-making consistently shows that beyond a certain point, adding more information actually degrades the quality of decisions by overwhelming the decision-maker and introducing more noise than signal. The investor who reads every analyst report, follows every financial news outlet, and monitors every piece of economic data is often worse off than the investor who selects a more limited set of high-quality information sources and thinks carefully about what they tell. The Zurich approach to information is qualitative rather than quantitative. Rather than asking, "How much information can I gather?" ask, "What quality of analysis am I doing with the information I have?" Rather than following the crowd of forecasters and analysts, do your own thinking. Rather than trusting the patterns you see in data, ask whether those patterns are statistically meaningful or merely coincidental. Information is a raw material, not a finished product. The finished product is judgment, and judgment requires not just information, but the intellectual discipline to process information clearly. The Zurich Axioms also have important implications for the role of leverage in investment. Leverage, borrowing money to invest, amplifies both gains and losses. When you invest with borrowed money, a favorable move in your investment produces gains that are larger than they would have been without the leverage. But an unfavorable move produces losses that are also larger, and if the losses are large enough, they can exceed your original equity and leave you with debts that take years to pay off. Given the Zurich Axiom's emphasis on mobility, on the ability to exit quickly and cleanly when things go wrong, and on never putting yourself in a position from which you cannot retreat, excessive leverage is clearly incompatible with the Zurich philosophy. The investor who is heavily leveraged into a position has given up their freedom to retreat cleanly. A relatively modest adverse move can force them out, not at a time of their choosing, but at the worst possible moment, when prices are lowest and the loss is greatest. Leverage is the antithesis of the Zurich principle of mobility. This does not mean that no leverage is ever appropriate. Moderate, carefully managed leverage in positions where the investor has high conviction and a clear exit strategy can sometimes be part of a disciplined approach. But the wild, unchecked leverage that characterizes some forms of speculation is completely at odds with the Zurich philosophy. Let us also spend a moment on the practical question of how you measure success when applying the Zurich Axioms. Because the conventional measures of investment success, primarily the comparison of your returns to a benchmark index, may not be the most useful measures for the active speculator following the Zurich approach. The active speculator who follows the Zurich Axioms will sometimes underperform the broader market in strong bull market years because they take profits early, because they avoid fully participating in consensus-driven bubbles, and because they maintain positions that have limited upside but meaningful downside protection. But they should consistently outperform in bear markets and corrections because they exit losing positions quickly, because they are not committed to holding through declines in the hope of eventual recovery, and because their pre-planned exit strategies keep individual losses small. Over full market cycles, which include both bull markets and bear markets, the disciplined practitioner of the Zurich Axioms should be able to achieve returns that compare favorably to a passive buy and hold approach, primarily because of the asymmetry in how losses are handled. The mathematics of loss recovery is brutal. If you lose 50 of your portfolio's value, you need to gain 100 of the remaining amount just to get back to where you started. Keeping losses small through the third axiom and through the related principle of not averaging down means you spend much less of your time and capital in recovery mode and much more of it building forward. There is a final dimension of the Zurich Axioms that deserves attention before we conclude, and that is their relationship to the emotional life of the investor. Investing, especially active speculation, is an emotionally intense activity. The highs of a winning position, the sinking feeling when something goes wrong, the anxiety of uncertainty, the regret of a missed opportunity, the temptation to take revenge on the market after a loss by making an impulsive new bet, these are all powerful emotional experiences that can override rational judgment at the worst possible moments. The Zurich Axioms are, among other things, a system for managing these emotions. By making key decisions in advance, before emotions are engaged, the speculator protects their judgment from being clouded by fear or greed in the heat of the moment. By accepting losses as a normal cost of doing business, they reduce the emotional intensity of the experience of losing, making it possible to cut and move rather than hold and hope. By setting predetermined profit targets, they protect themselves from the euphoria of a winning position, which can convince them that the winning will go on forever. This emotional management function of the Zurich Axioms is perhaps as important as their purely financial logic, because the failure of most active investors is not primarily a failure of intelligence or analysis. It is a failure of emotion management, a failure to maintain discipline when emotions are running high in either direction. The investor who can implement pre-planned decisions automatically, who does not let fear or greed override their system, has a fundamental advantage over the emotionally reactive investor, regardless of the relative sophistication of their analysis. The Zurich Axioms provide a framework for that kind of emotional discipline, not by suppressing emotion, which is neither possible nor desirable, but by doing the necessary thinking and deciding before the emotional moment arrives, so that when it does arrive, the appropriate response is already determined and simply needs to be executed. In the end, the Zurich Axioms represent something rare in the world of financial advice, a genuinely honest and genuinely practical approach to the challenge of making money in an uncertain world. They do not promise that following them will make you rich. They do not offer a magic formula or a guaranteed system. They offer something better and more valuable, a clear-eyed, experience-tested philosophy of engaging with financial reality as it actually is, rather than as we would like it to be. They tell you that risk is necessary and worry is healthy. They tell you to take your profits before they disappear and cut your losses before they grow. They tell you that forecasts are unreliable and patterns are often illusory. They tell you to stay mobile, trust genuine intuition grounded in experience, reject superstition, prepare for the worst even while hoping for the best, think independently of the consensus, move on from what does not work, and never mistake a plan for a guarantee. These principles will not make every investment you make a winner. Nothing can do that. But they will change the shape of your investment experience in a fundamental way. The wins will be real and banked. The losses will be small and clean. The decisions will be disciplined and consistent. And over time, the discipline will compound into something that looks like, and genuinely is, superior financial performance. The Swiss bankers of Zurich, who developed these principles, did not do so in comfortable offices, running theoretical models on computers. They did so in the trenches of real financial markets, across decades of real economic history, with their own real money at stake. The lessons they learned were paid for in experience, some of it painful, all of it instructive. The gift they left, through Max Gunther's careful documentation, is a distillation of that experience into principles that anyone can understand and apply. The question is not whether these principles are correct. History and experience have validated them repeatedly, in market after market, crisis after crisis, across generations of successful speculators who found their way to the same core insights by different paths. The question is whether you have the discipline, the honesty, and the courage to actually put them into practice, to go against the comfortable conventional wisdom, to make the uncomfortable decisions that the axioms call for, to trust the principles even when your emotions are pushing hard in the opposite direction. If you can develop that discipline, if you can internalize these principles deeply enough that they become automatic, not just intellectual positions you hold, but actual habits of mind and action, then you will have something that very few investors possess. You will have a reliable, experience-backed, emotionally honest framework for navigating the uncertainty of financial markets. Not a guarantee, not a certainty, but a systematic edge applied consistently over time that can make a real and meaningful difference in your financial life. That is the promise of the Zurich Axioms. Not easy money, not a shortcut, but a better way of thinking about and engaging with the endlessly challenging, endlessly fascinating, endlessly unforgiving world of investment and speculation. A way that was learned the hard way by people who had everything at stake, and that has been tested and refined and validated across the full sweep of modern financial history. The Zurich Axioms are not for the faint-hearted. They ask you to worry productively, to act decisively, to think independently, to accept losses gracefully, and to maintain discipline under pressure. But for the investor who is genuinely committed to improving their financial outcomes, who is willing to challenge their own assumptions and discard the comfortable but unreliable conventional wisdom, they offer a path that is as close to a proven approach to successful speculation as anything available. What you do with these principles is, of course, entirely up to you. But if you choose to take them seriously, to study them, to reflect on them, to gradually incorporate them into the way you approach financial decisions, you will be joining a tradition of disciplined speculative thinking that stretches back through the extraordinary men and women of Zurich who first developed it, through the generations of successful investors who have applied it, and forward into a financial future that will be, as it has always been, uncertain, challenging, and full of opportunity for those who know how to navigate it wisely. The Zurich Axioms invite you to become that kind of investor, not the kind who passively hopes for the best and endures the worst, but the kind who engages actively, thinks independently, acts decisively, and builds real, lasting wealth through the application of hard-won wisdom and rigorous, honest discipline. That is the invitation. The choice, as always, is yours.